So today we'll talk about taxation, tax laws. Okay. See, by the government normally collect the taxes. Constitution is giving power for state governments and central governments to collect different types of taxes. So, but we will be focusing more on two types of taxes here, that is direct taxes and indirect taxes. State government can collect some taxes, central government can collect some certain taxes. So this is powers given to the governments as per the constitution. Okay, so why taxes is collected? Because government requires some revenue for different purposes. Okay, administration, security, whatever it is, will not go in depth. That is the theoretical part. So taxes are collected for revenue, so that government can do some development activities. They can protect the country, policing, defense, judiciary, welfare schemes, lot of things. Okay, so for that purpose, taxes are collected. Okay, so there are different principles for taxation. Taxation will be collected so that canon on equity. They're called canons of taxation. Okay, canons are principles. Let us say canons. We can call them as principles also. Canon of equity or equality, canon of certainty, canon of convenience. So certain canons are there. Canon of economy. See, principle of economy. Canon of economy means principle of economy. So that when you are collecting tax, let us say you are collecting tax of 100 rupees. Sometimes what happens, for collecting tax, government had to spend more than 100 rupees. So it is not feasible to collect such taxes. Canon of economy means, so you should, it should be economical to collect the tax. So tax income should be more than what you are paying to collect the tax. So you are having income tax people, department, different mechanisms, all those things. If you are able to collect 1 lakh rupees from all the department and you are spending more than 1 lakh rupees on salaries and miscellaneous administrative work, so it is not against the principle of taxation. Canon of convenience. So how the tax is collected, it should be conveniently collected. So canon on equality. So it should be equality, or equality means taxes should be collected based on the ability of the person. Okay, it should be progressive. Low income people or low quality products should be taxed less, premium quality or luxury items should be taxed more. Okay, such things are called principles. Okay, so basically the principles are for government to frame the tax rules, how to collect the taxes, all those things. And there are taxes are classified into two things. One is direct taxes and another is indirect taxes. Direct taxes are income tax, corporate tax, wealth tax. Now wealth tax is not there. Since long time wealth tax is abolished. Only income tax is there, corporate tax is there. Income tax is direct tax. It is taxed on our income. Okay. So how much income we are earning in a year, we have to pay tax on that income. That is income tax. Okay. We are paying directly on our income. How much money, whether you spend, save, whatever you do, it is immaterial. So you are earning 10 lakh rupees this year. So for 10 lakh rupees, there is a calculation. So you have to pay so much of income tax on the 10 lakh rupees. That is simple calculation. You have to pay directly. Corporate tax is for the companies, corporate companies, like many corporate companies are there. So it is for them. So indirect taxes. What is indirect taxes? Here, tax, I am not paying tax. Okay, indirect tax is not paid by me. So the burden is shifted on somebody. I am collecting tax and paying to the government, but I am taking from somebody. Okay, I am not paying from my own pocket. Income tax I am paying from my own pocket. I earn 1 lakh rupees. On that I am paying 10 lakh rupees, 10,000 rupees. Whereas indirect taxes, I am supposed to pay 10,000 rupees. So I am not paying from my pocket. I am taking it from somebody and paying it to the government. I am acting as a middleman technically. So let us take example of GST, custom duty, excise duty, VAT, service tax, which were now part of GST. So let us take GST. So when you are buying a product, let us say you are buying a mobile phone. So mobile phone, it is 10,000 rupees is the price, let us say. GST is 18%. So 10,000 plus 18%, 11,800 rupees is the cost the distributor or dealer is collecting from the customer, from you. You want to buy the phone, you have to pay 11,800 rupees. So the phone cost is only 10,000 rupees. GST, goods and services tax, that is 1,800 rupees, 1,800 rupees is the GST on the mobile. So who is paying? The consumer is paying. Shopkeeper or the dealer is collecting that 1,800 rupees and he is sending it to the government. He is depositing in the exchequer, government exchequer. So it is indirect tax. Who is paying it? Consumer is paying, but it is collected by the dealer. He is not paying from his own pocket. So the burden is passed on to the end user, another person. Okay. Same thing, custom duty also. Custom duty is collected by, I am buying some, importing some products. I am paying the custom duty, that is transferred again to the end user. Excise duty is now merged with GST, but there is certain excise duty still continuing. The state governments are collecting excise duty, not central government. Central government is also collecting some small part of excise duty on petroleum products. So excise duty is also value-added tax only. On petrol and liquor, state governments are collecting excise duty. So whenever that money is, whenever you are buying 1 liter of petrol, they will charge, let us say 20 rupees as excise duty, state excise duty. That petrol company will transfer that 20 rupees to the state government. Okay, that is excise duty. So it is indirect taxes because you are not paying to the government. You are buying the petrol, you are paying to the dealer. Dealer is paying it to the government. That is indirect taxes. Direct taxes, you are paying directly to the government. Indirect taxes, somebody is collecting on behalf of government and they are depositing it. Another, I am talking only about concepts in this session. This is not going to be a continuous session. Okay, the topics will keep on changing. So because income tax, I don't want to talk about how tax is collected, what is this thing. So we are talking about important concepts where you require some clarifications, where you need to understand something. So I'm taking only concepts in these sessions. Even company law will talk about only concepts. Okay. Financial year. Okay. Income tax, we have certain terms. Financial year, accounting year, then okay, previous year is there. I think I didn't put previous year here. Previous year and assessment year. Okay, I'll add that slide later. Previous year is also very important. Assessment year is also very important. Okay, so financial year is the year in which income is earned. So this is financial year. What is this financial year? 1st April 2025 to 31st March 2026 is this financial year. Okay, so for the income earned in this year, we have to pay income tax. Okay, accounting year is also same, financial year is also same in India. Okay, but for foreign companies, some companies may take accounting year differently because for their company government purposes, for their accounting, but they may be having different accounting year. But when they are filing income tax return, they have to adjust that period and they have to match the Indian financial year only. Okay, same time, the previous year is also same, financial year only. Okay, previous year is also same like financial year. I'll tell you the concept of assessment year. If you are having doubt, you just unmute and ask here only. Assessment year is for the income tax department where they will charge income tax. You are assessed for that income tax in that year. Okay. So assessment year 2025-26. Let us take assessment year 2025-26. This is the assessment year. So in this assessment year, you have to pay income tax for the previous year. Previous year is 2024, 2025, 24 March, 1st April 2024 to 31st March 2025 will be the previous year. Assessment year is where your income is assessed. So your income is assessed in this year. Okay, but you are paying tax for that income for that last year, which you have earned in the last year. That is called previous year. So previous year only for income tax purposes, for which you are paying tax. When you are paying the tax, you are paying in this assessment year. So assessment year will be 2025 to 26. You will be paying tax for the previous year. That is 2024 to 25. You are paying tax in this year. Clear, Gunda? So financial year, accounting year, assessment year, అన్ని సేమ్ అనుకోండి మీరు. ఓకే, సో లాస్ట్ ఇయర్ ఎర్నింగ్ 1st April 2024 నుంచి 31st March 2025 వరకు ప్రీవియస్ ఇయర్, దాన్ని ఇన్కమ్ ట్యాక్స్ వాళ్ళు అసెస్ చేస్తారు ఈ ఇయర్ లో. సో ఆ ఇన్కమ్ ని ఈ ఇయర్ లో అసెస్ చేస్తారు కనుక అసెస్మెంట్ ఇయర్ విల్ బి 2025-26. దట్ ఈస్ ఇయర్ ఉండదు, జనరల్ గా ఇయర్ చెప్తాము. అసెస్మెంట్ ఇయర్ విల్ బి 2025 to 26. ఇన్ దిస్ ఇయర్ యువర్ ఇన్కమ్ ఈజ్ అసెస్డ్. ప్రీవియస్ ఇయర్ ఇన్కమ్ ఈజ్ అసెస్డ్ నౌ అండ్ యూ హ్యావ్ టు పే ట్యాక్స్ ఇన్ దిస్ ఇయర్. దాన్ని అసెస్మెంట్ ఇయర్ అంటారు. ఓకే, ప్రీవియస్ ఇయర్ నేను ఆల్రెడీ చెప్పాను. ఇంకొకటి, అనదర్ ఇంపార్టెంట్ థింగ్ ఫర్ ఇన్కమ్ ట్యాక్స్ పర్పసెస్, ద ప్రీవియస్ ఇయర్, that is not there. Okay, anyhow I'll put that slide. That is very important question. There was a question. So your business is started on 30th March 2025. When? 30th March 2025. So how you will be, what will be your assessment year? So for income tax purposes, any year ending 31st March is the previous year. Even if it is for one day, you have to take it as a previous year only. So assessment for that one day, you have to pay tax if you have earned anything, or else you will file a zero return tax. So your assessment year will be 1st April 2025 to 31st March 2026. But your previous year will be 2024 April 1st to 31st March. But only one day is also counted for that only, because it is for that period. Income earned in that period will be taxed in this year. So income earned, so it can be 1 day, 1 month, 2 months, 3 months, whenever you start that business. But if your previous year falls within 31st March, you have to take even for 1 day also, it is previous year only for income tax purposes. You remember this very carefully. So sometimes they will call, so 31st March I started the business, 2025, what will be my previous year, what will be my assessment year, what they may ask any type of question. So be clear, previous year will be 31st March 2025 only, 24-25. Assessment year will be 25-26. For that, even if you do business only for 1 day, you be very clear. Okay, clear? Any doubts? So section 3, actually section 3, I don't know why I went it. It may be somewhere in between also, I don't know. Section 3 of the Income Tax Act, just I am opening the tax. So previous year means financial year immediately preceding the assessment year. Okay. Financial, under section 3 of the Income Tax Act, the previous year means the financial year. See here, they are using the word financial year. Immediately preceding the assessment year. Okay. So even if your previous year starts for, have is only for 1 day, your financial year will be, and previous year will be 1 day only. But it will be calculated, assessed in the 25-26. So what is assessment? This is, I think section 2(9). Okay, section 2(9) defines about assessment year. So year in which income of the previous year is assessed and taxed. Okay, this is section 2(9). So section 2(9), 6, 11, all those things will come. Definitions they may ask the assessment year, which is that section. What is the 2(9)(3)(4), whatever they may ask. Previous year is section 3. It is not defined in section 2. Normally definitions are there. Okay. This is another important. Last year they have asked this question. Tax avoidance, tax evasion, tax planning, tax management. Okay. Tax avoidance. Avoiding tax is not illegal. It may be not ethical, but income tax or criminal acts, they will not, if it is ethical, not ethical, law will not prohibit. Okay. If it is illegal, then only they will punish you. Okay. Penalize you. So tax avoidance is not penal, I mean, it is not a crime or illegal. Tax avoidance means you are planning your tax in such a way that you are reducing your tax liability using some loopholes or some means in the Income Tax Act. You are not violating any act in the income tax. Okay, you are using some loopholes to avoid some tax. Okay, you are using all legal means only. It may not be ethical, but you are using legal ways. Tax evasion means you are cheating the government. You are not paying tax. You are not disclosing some income. Black money, whatever you say, tax evasion is black money. Tax avoidance is not black money. Tax evasion means you are earning 1 lakh rupees. You are not showing that 1 lakh rupees. Okay. Tax avoidance, you are saying that you are earning 1 lakh rupees. You say that I'm not going to pay tax because there is so much of exemptions I am taking from this one. You are taking exemptions. You are showing some expenditure, legal expenditure, and you are not paying any tax. Tax evasion, you are not showing that income at all. Okay. You are not showing that income. That is evasion. Okay. Tax planning means you are planning your tax so that you will reduce your liability. You are investing some in mutual funds, you are investing provident funds, you are in insurance, so and so. That is tax planning. Okay, tax management, it is nothing but it is the process of filing your return, timely filing of returns, how you are managing your tax, depositing your money in, I mean, timely depositing advance tax payments, maintaining proper records, proper vouchers, all those things you are maintaining proper management is tax management. So these 4 are important concepts. Tax avoidance is legal. So you are doing such things that you are not paying tax, but you are showing your income. Okay. I'm doing it legally. Tax evasion, you are not disclosing your income. It is illegal. Tax planning is you are showing your income. You are using government given facilities to reduce your tax liability. Tax management is about how you are planning your tax, paying income tax returns on time, maintaining records, complying all other rules of income tax is tax management. Another important terms is resident and ordinarily resident, resident and not ordinarily resident and non-resident. Okay. And there are other things I'll just see. Heads of income should be there. One more important thing, people, you may get question, agriculture income is not taxable. But if you are having 2 types of income, I mean, you are having a salary and you are having an agriculture income. Let us say you are having a salary of 10 lakh rupees and you are having an agriculture income of 8 lakh rupees. So for tax purposes, agriculture income will be added to your tax. Okay. After calculating tax, agriculture income will be removed again. So there is a calculation, you should go in depth of calculating that way also. But agriculture income is exempted in India, not taxable, not taxed. Okay. So there are different types of, see, resident and ordinary resident. resident and not ordinarily resident, and the other is non-resident. So for non-resident, see the main reason why these things are given, they will call who is resident, who is not ordinary resident, all those things will be given. Okay, so it is basically for tax purposes. Who will be taxed? Who will be not taxed? So resident and ordinary resident, I think next slide will help. Okay, so if you are a resident and ordinary resident, your income will be taxed whether you earn in India or you earn in other country. Also, you have to pay income tax in India. You may be paying income tax. You say, let us say you are in India, you wrote some book and that book is sold in America and you got say 1 lakh rupees or $1 lakh. So when you get $1 lakh, America, USA, they will deduct some tax deducted source. So they will send $70,000 to India. So you have to pay income tax again in India on that 70,000 rupees, $70,000. So resident and ordinary resident, you have to, it will be income will be taxed wherever, whether you earn it in India or you earn outside India. Okay, resident but not ordinary resident. Okay, Indian income only is taxable. And foreign income from Indian business is taxable. Okay, if you are, say you are giving professional services, you are going abroad, you are working there as an employee, your salary is not taxable there. Okay, some people go on business visa. Okay, I mean H1, the H1 visa is one for employment there. There is another visa where you go for a short term, 3 months, 6 months duration. So Indian companies will send you to US for temporary purpose, a small period. For that period, you get certain amount as a salary there in that country. So that income is taxable because you are resident and ordinary resident. So resident but not ordinary resident, you earn salary there, that income is not taxable. Only Indian income is taxable. Okay, so who will get, sir, India income and US income? So there are certain people, you may be having some property in India, you may be getting rent in India. Okay, so that you have to, even if you are working there in America, you have to pay income tax on the rental income. Okay, so but you are having a property in America, you are getting rent on that property, you need not pay if you are a RNOR, resident and not ordinary resident. But if you are resident and ordinary resident, even if you are getting rent in America, you have to pay income tax here. You have to pay there, you have to pay here. Okay. If you are a non-resident Indian, only income earned in India. Okay. So only small difference because resident but not ordinary resident and non-resident, small differences from Indian business is there. Here, Indian business also, it is, if you are a non-resident, you are exempted. Okay. So what are the conditions? There are certain conditions. This question also you can expect. This is very important conditions. Resident and ordinary resident, ROR, RNOR, NR. These three things for tax purposes. So any person who is staying more than 182 days, okay, is one of the basic condition. Step 1, 6, and this is section 6.1. An individual is resident in India if he satisfied any one of the following. There are any one of the following. He stays in India for 182 days or more during the relevant previous year. Previous year we learned in the last session, last slide. So where income earning is taken. So in the last year, if you are staying 182 days or more, you are called resident. You are called a resident. If you are staying less than 182, you are non-resident. Okay, that is simple. This is basic criteria. Or, see, another condition also there. If he stays in India for 60 days or more in that year and 365 days or more in 4 preceding years. So last year, here they are taking 5 years, previous years, 5 previous years. Let us take simple way. So last year you stayed only 60 days, more than 60 days. Let us take it as 61 days. But you stayed for 365 in the last 4 years, in the preceding years. Not, don't take last previous year. In the preceding year, you have stayed for 365 days. Okay. So here you are called as a resident. Okay. Then there is second condition. So second condition is to check ordinary resident. If you are not there for 180 days, you are non-resident. Simple. You are last, these two conditions are not satisfied. Say, let us say you are there for 30 days in India only last year. So you are non-resident straight away. You are there for 59 days. You are non-resident. You are there for 60 days. Then they will look for the last 4 years, whether you stayed in 365 days or not. If you are not staying for 365 days in last 4 years, then also you are not a non-resident. Okay, now you are a resident in India. So then second condition will come. He has been resident in India in at least 2 out of 10 preceding years. Okay, resident, that means let us take only one condition. You are there in India for 180 days last year, and you are resident of India for at least 2 out of last 10 years. 10 years they will take. In the 10 years, you are there, you are resident. I mean, you have qualified that 182 days qualification. You were there for at least 2 years in last 10 years. Preceding this year, you take this except this year, they will take 10 previous years. And in those 10 years, even though you stayed for 2 years, you are a resident for 2 years, then you will be taxed. Or other condition, and he stayed in India for at least 730 days during 7 preceding years. Again, another condition, 7 preceding years also you, and this is another condition. So you should fulfill the second condition also. 2 years you should be resident, and in the last 7 years, 730 days should be there. And last year you should be there for 182 days. These 3 conditions, then only you are resident and ordinary resident, so that anywhere in the world, if you are there, your income will be taxed. Okay, that is the reason a lot of NRIs, they will run away after they don't stay more than 60 days in India. Okay. Okay, here I gave this assessment year and previous year. This slide should go here actually. This slide should go here. Okay. Assessment year, section 2.9, assessment year means the period of 12 months commencing on the first day of April every year. The assessment year is the year following the financial year in which income of that financial year is assessed and taxed. Okay, example, you financial 2024 assessment year will be 25-26. Previous year, section 3, provided that in that case of business is newly set up, here I gave that condition. In the case of a business or profession newly set up or source of income newly coming into existence, in the said financial year, the previous year shall be the period beginning from the date of setting up of the business or profession. Beginning from the date of setting up of the business. So you started your business on 30th March 2025, and your previous year will be from the day you started your business and the last date of the previous year, that is 31st March. So it is very clearly given. Even if it is 1 day also, you have to take that. Provided that in case of business or profession newly set up or a source of income newly coming into existence, in the said financial year, the previous year shall be the period beginning with the date of setting up of business or profession, or as the case may be, the date on which the source of newly income newly comes into existence, and ending with the said financial year. This same question has come in last year or previous year. And let me tell you one thing, the best of the classes, online classes, you take any name, everyone answered this question wrong. Okay, everyone answered this question wrong. You take, there are 3 to 4 people, top people, most of the students may be attending their sessions also. They answered this question wrong. This question was there. Then I saw. Then I kept quiet because I am having income tax experience, so I am able to. I know the answer for this one. So lot of advocates, they don't have income tax background, so they answered this question wrong. This question was there in last year or previous year. I don't remember exactly. So everyone answered wrong. Lot of top coaches of AIBE who are charging 2,000, 3,000, 4,000 rupees for the sessions, 2-month session, 3-month sessions online. They are having apps. All those people, they got this question wrong. So what I'm saying, even I will answer some question wrong. You will answer those questions wrong. They also answer. Best of the people, they go wrong on certain questions. Okay, so don't take it wrong. But I want to give clarity on this one. Okay, then income is classified for income tax purposes. Income is classified into 5 different heads. Okay, 5 heads are income from salary, income from house property, profits and gains of business or profession, capital gains, income from other sources. So your income tax will be taxed under 5 different heads. Okay, income from salary. See, if we are having income, you may be having income from 1 head. You may be having income from 2 heads, 3 heads, 4 heads, 5 heads. Maximum 5 heads are there. So even if you are having income from 1 head, it will be taxed. If you are having from 2, say income from salaries, 1 lakh rupees. Then income from other sources, 1 lakh rupees. Simple, 2 lakhs, it will be your income. So income will be taxed in 2 heads. Total income will be taken as 2 lakh rupees. On 2 lakh, income tax is calculated. Okay, except capital gain. Capital gain, it will be taxed separately. But capital gain taxes, short-term capital gains again is included. Capital gains, I will talk about the capital gain again. So income received by an employee from an employer. Okay, here relationship is income received by an employee from an employer. So next we'll be taking session on company law. I'll talk about this one. I'll explain. If it is a private limited company or a limited company, you are taking a salary. Partnership also, you are a partner, you are taking a salary. Then it is taxed under income from salaries only. You are controlling entire company. All shares belong to you only. Okay, 1% company. You are the only 100% shares are with you. You are taking salary from the company. It will be taxed under income from salaries. Okay. Income from house property. Only rental income. If you are having any property, rental income from that property is taxed under this head. Income from house property. There are certain exceptions, calculations where you pay, property tax are there. Certain for maintenance, they give certain exceptions or exemptions are there. So rental income from building or land is taxed under income from house property. Profit and gains of business or profession. If you are doing some business, let us take, you are running a kirana shop, you are running a factory, it is a business. So if it is a private limited company, it is business income. If it is an individual proprietary company, it is your personal business. So individuals also, even if you are having business in different names, you may be having, you are a proprietor of 5 different companies, A, B, C, D, E. Okay. All 5 companies, you will show separate profit and loss account. You take all the profits together. You will show that total profits of 5 businesses as income from business under this head. Okay, you may be having 10 businesses also. It will be shown here. You are an advocate. So profits and gains of business or profession. So you will be showing it as a professional income. Our income as an advocate will be professional income, not a business income. But it will be shown under this head only. Profits and gains of business or profession, it will be shown under this head. Even advocate's income or disclosed or taxed under this head. Capital gain is you are having a asset, capital asset. Capital asset can be building. Capital asset can be anything. Gold is a capital asset. Shares are a capital assets. So you are selling your property, share, gold, whatever it is. you are making some profit. You bought it for 1 lakh rupees. You are selling it for 1,10,000 rupees. The 10,000 is capital gain. That will be taxed here. Okay. You purchase something. You are selling it for profit. It is not your business. If you are selling and buying, you are a jewelry shop. You are selling gold. Then it will come under capital, business income. Okay, profits and gains of business. You are an individual, you are an advocate, you purchase some land, you are selling it for profit. That profit is a capital gain. Okay, income from other sources. All the other income. So it is not a salary, it is not a house property, that is rental income, it is not a professional income, it is not a capital gain. Other income is there. What is the other income? Generally, you get some commissions, you get interest from the bank deposits, you get dividends from the shares you hold. All those things will be taxed under income from other sources, which are not taxed in these 4 heads. It will be taxed under income from other sources. Okay. I think I should make it fast. We are okay. So again, there are 2 types of capital gains. Long-term capital gains, capital asset. See, what is capital gain is taxed on capital asset. Property, shares, mutual funds, gold, all are capital assets. So if you are holding it for longer period and selling it is a long-term capital gain. If you are holding it for short-term, it is short-term capital gain. So what is short-term? What is long-term? I'll explain. Okay. If you are holding it for long-term and selling that asset, the profit on that asset is long-term capital gain. If you are holding for the short-term is the short-term capital gain. So tax purposes, long-term capital gain is not added in the capital gains heading. It will be taxed separately, but short-term capital gain is included there. So period of holding, if you are holding shares or in mutual funds, if you are holding less than 12 months, it is short-term. Okay, if you are holding more than 12 months and selling it, it is long-term gain. Same thing, unlisted shares, it is 24 months. Immovable property, that is land and building, it is 24 months. Gold and other debentures, debt funds, it is 36 months. Okay, so if you are holding gold for 36 months and selling after 36 months, it is long-term capital gain. Long-term capital gain is taxed up differently. Short-term capital gain is differently taxed. Okay. So, okay, done. These are the income tax related things. So any things we'll try to answer them separately. I'll see if there is anything I missed. I'll go through the notes. If anything is missed in income tax important topics. So there are, so in income tax, another important things are taxpayers, types of taxpayers are there. Okay. So individual, I am paying as an individual, proprietor is an individual. As a professional advocate, you are an individual. So there is another way, Hindu undivided family, where family in income tax, they give another head is Hindu undivided family, HUF, what we call. So income of the family, say, let us say there is a business which is from your hereditary, your father gave that business, you and your brothers are running. So that income can be treated as a separate head, income from Hindu undivided family.
So
that will be
sorry to disturb you. If Hindu undivided family advocates are there, then they are part of earning in other source, or how could we understand?
No, advocate is income from business or profession.
No. What I'm trying to say is, sir, if is a person from Hindu undivided family, okay, that means he is also part of that family.
Yes,
no?
yes,
So
yes.
so in that
case, will be taxed separately. Say, let us say you are having a family business. Your brother is running. You are an advocate. Okay, you are having share in that family business also.
Yes, sir. That is what.
But Hindu undivided family, karta will be assessed technically. But okay, let us say you are karta also. Let us, just for academic purposes, I am saying. Okay, you are karta. So Hindu undivided family, head of the family, HUF is called karta.
Yes.
So
yes.
you are having a HUF and you are having a separate own business also. You are having a separate business also. HUF is business coming from your parents, from the joint family. But you started another business as a individual proprietor.
No, I'm not talking about that one,
just
sir.
I'm giving an example. I'm giving an example.
Okay. Okay.
Okay, so you will be taxed twice. One is Hindu undivided family, that income is taken separately. Okay, your individual income is taxed separately.
Yes.
Okay, so
Yes.
what is happening? See, why they do HUF and individual? Because there is basic exemption, 3 lakh rupees, 5 lakh rupees, whatever is the basic exemption. You can avail those exemptions separately. Say, let us say you club all both incomes together. Your income is 10 lakh rupees. So you have to pay income tax, and 5 lakhs is exempted. On 5 lakh rupees, you have to pay income tax.
Yes.
Okay.
But
But if
after
you are
this
having
new,
a HUF, if you are having an HUF, you are having 5 lakh rupees on HUF, you are having 5 lakhs as on your own individual. So your 5 lakhs is exempted and HUF 5 lakhs is exempted, basic exemption. So you are
so
not paying any tax even though you are earning 10 lakh rupees. So
that
that
means
is
he
the
can
benefit.
enjoy both.
Yes, that is the advantage.
Sir,
If
okay,
you are
that
an
is
advocate,
that part is fine. But you do not have any business separately, but you were part of the HUF. Then in that case, he is eligible to practice.
yes, yes, HUF you can practice.
Sir, it's okay.
Yes, 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 you can practice because you should not be karta.
Yes, yes, of course. If you
You
were
should
part
not
of
be
the family,
karta.
okay, but you should not be
Yes,
karta.
you should not be
But
karta.
individual farm we cannot maintain. We should not part of that individual
Yes,
business, and we
yes,
should not
yes,
be.
yes, yes, yes.
Okay,
So,
sir.
okay, so that for that benefit only, small benefit of 4 lakh, 5 lakh rupees initial benefits and tax slab rates, they have HUF separately.
But
Okay, they will have
any
separate individual taxation separately.
But anyhow, now this year it has been changed now, sir. 12 up to 12 lakhs you can enjoy the
Nahin, nahin. So
zero.
you will have 12 lakhs HUF, 12 lakhs individual also, right?
Yeah, yeah, that is what. Sir.
Yeah, so just giving an example for tax exemption purposes only. But let us say if you are having income of 10 crore rupees, how much saving you will do? HUF and
Mhm.
so that doesn't make any
Yes,
much difference. So it is
yes.
only for small initial
Small,
earnings only.
yeah, yeah.
Okay.
Small
So for
brackets it can
huge
be.
earnings, it doesn't make much difference. So say you may save 50,000 rupees, 1 lakh rupees.
Yeah,
If your earning is
yeah.
10 crore rupees,
There is
saving of
some
50,000, 1 lakh rupees is meaningless, right? So it
yes.
is, once you go beyond certain limit, these exemptions are meaningless. Okay, this is for small income salaried people only, that benefits are there. Then after HUF, then it is a company, private limited company, public limited companies, they are taxed. Okay, then partnership firms are taxed separately. Partnership firms, see company, see individual, you are having separate PAN card. HUF is also you will have a separate PAN card. Partnership firms also you have a separate PAN card in the firm name itself. So say let us say I am Srikanth. I'm a Karta of HUF. So I'll have Srikanth HUF PAN card. Srikanth individual PAN card separately. I'll have two PAN cards. Srikanth HUF PAN card will be there. Srikanth individual PAN card will be there.
But is it possible, sir? We can get like that because
Yes,
one person
HUF they will give HUF PAN card you get separately.
Achha, achha. Individual we can have separate and HUF we
Yes,
should
yes,
have
yes,
to
yes.
apply
As a
for
Karta you
separate.
get separate PAN card. Okay. So
But part of the HUF also you should have to PAN card separately or individual
yes,
can
yes.
enough.
Without PAN card you cannot file. See, for every income tax returns it is filed on a PAN card only.
No, no. So what my question is, individual everybody having separate, okay. But when
Yes, yes.
you part of HUF also, you should have to get HUF individual PAN card or this one is
No,
enough.
no, no, no.
Individual.
See, HUF, all one only Karta will be having PAN card in the name of HUF.
Remain they do not.
Remaining people will not get. So the person
Okay.
expired, let us say Karta is expired, next somebody is becoming Karta, then they will
Yes.
update that one and new Karta will get that PAN card.
Yes, yes. And but one small doubt again. Earlier days, male people only karta. Nowadays, everyone can have a karta, sir, right?
No, I think even now it is mail only. I had to check that one. I'm not aware of the latest update. There is some changes,
That is
but
what. That is what.
they got, see, Hindu undivided family only gents are part of that in the HUF.
Males
So
only, no, sir?
yeah, but now females are made part. There's
Yes,
some
yes.
changes are made because
Yes,
latest
they are
development. I'm
part
not
of
practicing
HUF.
tax. I'm not
Yes, yes.
practicing tax. I was practicing
Okay.
tax long
No,
back, 20 years back. I
no.
was
It's
practicing
okay.
tax.
It's
So
okay, sir.
these days I'm not practicing tax. I'm not keeping update about those changes in the tax laws
No
because
problem.
we are not getting any
Thank you.
tax cases also. They are
Mm.
going, the chartered accountants are doing tax cases in tribunals. So people are
Mm.
not asking us. So we are not doing any tax cases. But
Anyhow,
anyhow,
no
since
issue,
I
sir.
had tax knowledge, I was
Yes,
practicing
yes.
in 1996, 97. I was practicing income tax. So I'm
Sure.
having some knowledge. So I'm able to
No.
tell those things. So
Okay.
Then company and firm also, they tax separately. Okay. Then another important, now we will come to company law concepts. You got it right? So we'll talk about some important terms of company law.
Yeah.
So I'll just give an example of a company. So you are doing business. So you can do business as a sole proprietor. I mean, you are doing business. You will not have a, let us say, your company name is ABC Trading Company. Okay, it is a proprietary concern. You will not have a separate PAN card. You are having XYZ Trading Company also. You are having two businesses. Those two businesses will not have the PAN cards. Because you are proprietary, your PAN card will be that business PAN card also. Okay. Even when you are going for the GST, you are giving your personal PAN card and GST will be, see, GST number is PAN card plus some extension, 1-2 numbers extra. Okay. So your GST number also will be two separate GST. Say your PAN card number is 1234 and ABCD 1. Then your for first business, second business 1234 ABCD 2 will be your PAN card GST number for the second business. So you may be having multiple GSTs, but PAN card will be same. You will be taxed as individual only. All those incomes will be clubbed in one place and will be taxed as income from business, income from ABC, income from XYZ, income from whatever businesses, multiple businesses you are having as a proprietor. All those things will be taxed under income from business as a proprietor under single PAN card only. Then second thing is partnership. Partnership will have a separate PAN card. It will be in the partnership name. There will be 5, 10, 20 partners. So those people, it will be taxed in the partnership firm name. Partnership firm will pay tax. Income coming from the partnership firm is not taxed. So let us say there are 5 partners in the company, partnership company, 5 lakhs is the profit. Your share is 1 lakh rupees. You are taking that 1 lakh rupees. But on the 5 lakh rupees, firm will pay a certain amount of tax, 20%, let us say. That is 1 lakh rupees they have paid the tax. 4 lakhs is distributed between 5 partners, that is 80,000 each. So that 80,000 is tax free. You will show that income, but is exempted income in your income from business. Under
Because
heading,
already paid tax, it should not be double tax. That is what, right?
Yes,
Right,
yes,
sir?
yes. You will show as income from business only, but again you will show that as an exempted income from business, partnership business. You will show it again and you will deduct that income. Okay, you will show it as income from partnership business 18,000, exempted income from partnership business 80,000. You will show it as 0. So you will show it as for just showing purpose. You will show that just academic purpose. Don't go in depth. That is a rule. Okay, there is no logic. Same time, private limited company. As now new companies are come. We'll talk about those different. So they will be having separate PAN card. Here partnership is 5 people, 6 people. It is the partnership between people. There is an agreement. But when it comes to private limited company, there is no separate agreement. Company is formed. You become a shareholder. You can buy shares and become a shareholder in the company. So any number of people can come. Any number of people can go. There is no separate agreement between the partners. Like partner, there is an agreement. Between shareholders, there is no agreement. Okay. Company is treated as a separate legal entity, separate from the shareholders.
Like big companies.
Not big company. I'll tell you example. Even 1% company is there, it will be treated as a separate legal entity. There is one very important case law I'm referring now. You should remember this case law. It is, I mean, holy grail, let us say Bible for company law. This particular case law. Solomon versus Solomon and Company. Okay.
Yes, sir. Yeah, remember.
I will give figures, wrong figures only, just for academic purpose. I'm talking about this one. There is one person, Solomon. Okay, he started a company called Solomon and Solomon Company Limited. Okay, Solomon Company Limited. In the Solomon and Company, there are 1,000 shares. Okay, 999 shares are with Solomon, and that one share is with his wife.
Right, right.
Okay, one share is with his wife. Okay, then Solomon, there was some requirement of money in the company. So Solomon invested, say, 10,000 rupees in the company from his own money as a loan to the company, not as a share. Shares he gave 1,000 rupees, 919 plus 1. So there was some requirement of money. So he gave 10,000 rupees as loan to the company. Solomon gave loan to Solomon and company, 10,000 rupees. But that money was not sufficient. Then he borrowed another 10,000 rupees from outsiders. Okay. So
Yes,
total
sir.
20,000 he borrowed.
Yes.
Now the company became bankrupt. Okay, they sold all assets. Okay, after selling all assets, company recovered 10,000 rupees. How much? 10,000 rupees.
10,000.
Now,
Yeah.
the outside borrowers, so Solomon gave money 10,000 rupees and outsiders, 4-5 people also gave 10,000 rupees. Those 4-5 people, they filed a case. This entire company belongs to Solomon. So the 10,000 should be given to us only. Because 999 shares are Solomon's, one share is his wife. So entire shares are with him and his wife only. So it is nothing but his company only. He is the company. So the 10,000 should not be given to Solomon. We should get the 10,000 complete money. That is the case filed in the court. But
So
what did
basic principle. Yeah, he's only owner. He's not the owner of the company. He's only director or partner of
whatever
the.
he may not be director, he may be director also. It doesn't make any difference.
Hmm.
So what did the court say? Solomon and company is different. Solomon is different.
Person
Even though
is
he is
individual.
holding entire shares, so
Yeah,
he
individual is
is,
different.
he is equal to you only. So the 10,000 will be divided between him and you all together. So that is the decision Solomon and Company Limited. That is very important case law. You should remember this case law. Separate legal entity. Company is treated, this definition you should remember, separate legal entity. Company is treated as a separate legal entity to the individuals, even though you are controlling 100% of the shares. Okay, you are not owner of the company, you are shareholder in the company. You are not the company. Okay, let us say now Solomon wife died. Okay,
Yes.
actually there is another thing, perpetual succession. Another thing we have to write here. I'll just write perpetual succession. We call it perpetual succession. So another concept is perpetual succession. Any private limited company or limited company, there is a thing called perpetual succession. Okay, what is perpetual succession? Let us say in this case, Solomon and company, I mean, his wife died because they died in 1900 itself. Okay, it is very old case, 1897 case. So they died in 1900 and 1910, whatever year may be. So we can take them as granted and let us kill them. Okay, so Solomon wife died, but company will still exist. That shares will be transferred to the legal heirs or whatever the as per will. Let us say they had a will, so they are transferred to somebody. They will become shareholders, but company will be there in the same way. No change in the PAN card, no change in the rules, nothing. Everything will be the same. Only the shareholders changed. Okay, company is same. No change in the company. Okay. So that is called perpetual succession. Company may, all shareholders die. They may not be functioning. Company activities are also stopped. Let us assume. But in law or in the books of company, Ministry of Corporate Affairs, MCA, what we call, company is existing even though all the shareholders died. Okay. So same time, if somebody has to file a case, they had to file a case in the name of legal entity because I'm 100% shareholder. They cannot file case against me. In a proprietary company, there is a check bounce. You will file check bounce in the name of the proprietor. Okay. Individual name you can file. In partnership, all the partners, you can file case. If one partner issuing the check also, you can file against all partners. In the company, you can file against the directors only, not against the shareholders. Okay. Check is issued by some director. All directors may be responsible. So directors need not be shareholders. Remember one thing. Directors need not be shareholders. Here, Solomon and company, Solomon need not be a director in the company. I may be the director of the company. So, if you are issuing a check, I'm talking about check bounce case only because individuals are also made part. In that case, directors may be held responsible and company will be held responsible, not the shareholders. So, in civil case, company will be sued, not the shareholders. It is different. That is the separate legal entity.
Shareholders, shareholders only belongs to, sir, what we can say, profit and loss, they are only, they will enjoy, but remaining,
yes.
yeah, sir. Understand, sir.
Okay. So,
sir, can you please share the file?
I'll make slides. Actually, I didn't make the slides for these things. I'll make slides and send it to you. I don't have the slides. So just for the purpose, just I'm updating also in front of you. Perpetual succession I added now. So I thought if I'm having some time, so we'll take it faster. So that is the reason I want to cover more topics because we are having less time. I want to do one more topic. So I'm taking this session on corporate law, company law. Okay. So this is very important. Okay. Ownership is again in the name of the company, not in the name of individual. Okay. Then I am talking about corporate will. Okay. It is related to separate legal entity. I am talking about corporate will. Okay. This is a new provision. Sometimes court will ignore that the company is separate legal entity and they may penalize the individuals. Okay. Wheel ante parada. Okay, corporate wheel anedi parada, corporate protection wheel. So that protection is removed in certain cases. Corporate wheel, lifting of corporate wheel, and I'm not here. I'll make it lifting of corporate wheel.
They're intentionally, if they're doing something
yes,
wrongly,
intentionally they are doing some fraud or something. Courts
yes,
or in law enforcement authorities will remove that protection. Separate legal entity protection is removed. That is called lifting of corporate will. Okay, you got it? So when some, let us say, company is there, Mahindra and Mahindra was there, let us say, in India, Mahindra and Mahindra company. So, of course, one Mahindra was in India. It was Mohammed and Mahindra and company. M&M is not Mahindra and Mahindra. It was Mohammed and Mahindra. When it started in 1940, they wanted to import Willys Jeeps from America and sell in India to Indian Army. So Mohammed and Mahindra were friends. So M&M, we call it M&M, Mahindra and Mahindra, they changed it. It was Mohammed and Mahindra. So
yes,
Mohammed stayed back in Pakistan. Mahindra came to India. So Mahindra paid money to Mohammed. Let us say it was Mohammed and Mohammed. So company is in India. Then it will be lifting of corporate will. That protection will be removed in those situations when it becomes an enemy company. Protection is also removed. Okay. So those are the things basically. Then I will talk about memorandum of association. Memorandum of association, whenever a company is formed, they have to file a thing called memorandum of association and articles of association. Memorandum of association, there are 5 clauses, main clauses. That is name clause. That is registered office clause, name clause. What is the name of the company you want to name? You will mention that name. Registered office, which state registered office is located? That will be mentioned in the memorandum. Object clause. What are the objects for which purpose the company is formed? That is object clause. Then there is a thing called liability clause. So whether the liability is, what type of liability these shareholders will have, that should be mentioned. That is liability clause. Then other last is the capital clause. How much capital they will be raising? How much capital the company is authorized? So that 5 clauses will be there in the memorandum. Okay. Then articles of association. So this is more about how the company is run, day-to-day affairs of the company, what are the, how the board meeting should be conducted, how the shares should be transferred, how the process will be run inside the company is defined in the articles of association. Okay. So here, okay, I gave it here, ultra virus. So if anything is done in the company, which is against the rules of memorandum of association, if something is done by the company or directors, which is against the provisions of those memorandum, those 5 provisions in the memorandum, then it is called ultra virus. There is no protection. Okay. But if there is any violation of articles of association, any violation, so I'll say here another called doctrine of indoor management.
Could you again tell me what is ultra virus? Could you again repeat it?
I'm writing another thing. Okay, I'm doing this. This is doctrine of indoor management. Another thing is called doctrine of indoor management. Another important concept. You may get questions. So just since I'm talking about ultra virus. So if any act committed by any director or anybody which is against the provisions of memorandum of association, it is ultra virus. So then you will get the protection. That is fraud, void that agreement. Let us say I'm running a company. I started a company. My objective of the company is to run a finance company. Let us say. Okay. Then I made an agreement with somebody to start a liquor business. Okay. Then I borrowed money from you for doing liquor business also.
Yes. Got sir.
I'm not paying you money. Now you can say, you cannot say that it is indoor management. I don't know whether there is objective is to start liquor business or to start banking business. I don't know, finance business. So I am unaware of that one. No, it is ultra virus. That contract is not valid, not binding on the company. They cannot sue the company because objects are very clear. Object clause, it is a public document. Memorandum is a public document. So they can go to the public document. It is clearly mentioned that this company started to do finance business. So they can sue me that I have cheated, but they cannot sue the company for the money. Okay, that is ultra virus and not binding on the company. Okay, doctrine of indoor management. Okay, then here doctrine of indoor management, let us say it is based on the articles of association. If there is anything beyond articles of association, any act done beyond the articles of association, it is binding on the company because outsiders need not know what is happening inside the company. So, whereas memorandum is a public document, articles is about internal management. If anything happens against violation of articles of association, I will get the protection. So, let us say 3 directors should sign and a board resolution should be passed that these 3 directors should sign the document. There was no board resolution. 3 directors signed the agreement. I don't know whether board resolution is passed or not. That is part of the internal management. I am protected. You got it? When there is a violation of articles of association, I am protected. That is doctrine of indoor management. When there is a violation of memorandum of association, that is ultra virus. So that is void ab initio. From the beginning, it is void ab initio. You can take that word also. You get it in even thoughts also. Void ab initio. From the day one, it is contracts also you get. So it is not a valid contract. It is not enforceable against the company. Doctrine of indoor management, even if there is a void, it is against the company. It can be enforceable against the company. Okay. So when a company is formed, they issue share capital. Okay. Share capital, there are different types of share capital. Okay, I'll talk about another important concept, types of companies. Here we are having these types of companies. I'll talk about types of companies. There are private limited company. Then there is a public limited company. There is one-person company. Okay. Then there are different, I mean, on the basis of liability, there are companies are classified based on members. Companies are classified based on different purposes for profit, those things. So basically, let us take, I'll club all together and give definitions of every type of company. Private limited company, public limited company, one-person company. Okay. Then there is government company. Then not-for-profit company. These are the basic types of companies. Okay. In private limited company, the minimum number of shareholders will be 2. Okay. The maximum will be 200. Shareholders can be minimum 2, maximum will be 200. Directors will be 2, maximum will be 15. Okay, maximum will be 15. Remember these things. In public limited company, the minimum number of shareholders will be 7. Directors will be 3. Minimum. There are 2. So maximum directors are also same 15. In one-person company, there will be only one shareholder. Directors can be one or more than one director. Okay. So main thing, that is the only thing, minimum directors, 2 for private limited company, 3 for public limited company, 1 for one-person company. Shareholders, 1 for one-person company. Minimum, I am talking 2 for private limited company, 7 for public limited company. Okay, this is the thing. Okay, then holding company is the one. If I am holding another company, I am called holding company. That other company will be called a subsidiary company. So small definition will be there that they are not important. Okay, then so if you are starting any company, so there will be shareholders. Company will be giving shares. So there will be again 2 types of shares: equity shares and preferential shares. Equity shares are generally ordinary shares also. So equity shareholders will have voting rights. Preference shares, they may be having voting rights. Without voting rights also, preference shares are given. So preference shares are only given because they have extra right. I mean, first preference will be given for them in case company is dissolved. Their money is paid first. If there are some profits, dividends are given first to the preference shareholders. That is only difference.
No, sir, that is only for liabilities. I mean, sir, losses occurred, then only preference.
No. Preference shares, losses occurred also when the company is closed. The first payment will be done to preference shareholders. Okay, any money after paying all the liabilities.
Yes,
Okay,
yes, that is
losses is same for preference shareholders, equity shareholders. No one is liable for losses of the company. They are not individually responsible. They need not pay.
Yes.
Okay, so they are protected from that losses. Shareholders are never asked to pay the money.
But they can lose the share what they invested, right?
Yes, that money is gone. Even preference share also, if there is no money, they will lose. But if there is some extra money, first will be given to preference shareholder, then to regular shareholders.
Means like dividends.
Dividend, or even if the company is closed, let us say the company is closed and there are 1,000 preference shareholders, 1,000 equity shareholders. After giving all the liabilities, 500 is left out. That 500 will be given to preference shareholders only.
Okay,
Not to equity shareholders. They will not divide between those 2 people. If there is more than 1,500, 1,000 will be given to preference shareholders, 500 will be given to equity shareholders in that case. Okay, then there will be another term called debentures. Debentures is loan. It is borrowing of the company. Company will borrow by giving, like shares, they are giving shares in the company. Similarly, they will give debentures for the borrowings. It is debt actually. Okay, it is debt. Company is borrowing that money. It is called debentures. Interest will be paid. So debentures can be repaid back. They will say, let us take companies borrowing by issuing debentures. After 5 years, they will pay back that money with interest, or they will pay interest every year. Or after 5 years, they will can convert it to, that is called convertible debentures. They will can convert it to shares also. That is there. So any public limited company, when they are giving shares, they have to issue a prospectus. Prospectus is nothing but it contains all the details about the company, the directors, the purpose why the money is required. If it is an existing company, last year profit and loss account, balance sheets, audit reports, key personal, all the details of the company, what is the money, purpose of this money, all those things they should give. That is the prospectus. It is like a brochure. We are giving it to the public that I want money, please invest in my money, invest in my company. So whether you are taking from individuals or public, you have to, every public limited company should issue a prospectus. So some companies, they don't issue to public shares. So even then they have to file a thing called prospectus. It is called prospectus in lieu of prospectus. Okay. Prospectus in lieu of prospectus. It is in lieu, in means in place of prospectus, they are giving something document. So it will be almost similar, but it is not a public document. Since they are public limited company, they are not issuing shares to public. They will just file a prospectus with register of companies. But here in regular thing, when you are issuing shares to public, you have to publish it in the public also. It will be given to public also. But prospectus in lieu of prospectus, it will not be given to public. It will just filed with the register. That is the only difference. Then there is another thing called red herring prospectus. This question has come there. I just included here because this question has come in 2 years back or 3 years back. Okay. So when prospectus is given, sometimes, see, when there is an existing company, let us take Tata Motors is there, they want to issue shares. Okay. So they are issuing shares for each share is 10 rupees, but they may issue it at a premium of 90 rupees. They will issue it at 100 rupees. That is 90 rupees is called premium. So they will sell it to the public at 100 rupees. So why you buy, why don't you buy? We will not go into that thing later. Okay. Shares are priced in the market, so they will give it at different rates. Okay. So they will be issuing at 100 rupees because they are expecting that shares will be sold in the market for more than 100 rupees comfortably. But some companies, they will issue prospectus, but they don't decide on the premium. They will give all the information in the prospectus, like what is the purpose, who are the directors, previous year accounts, all those things. They will give every information, but they will not mention the premium amount because they haven't finalized at what rate we have to give it to the public. Okay. So the premium amount is not giving. In that cases where the price of the share is not fixed, it is called red herring prospect. Such prospectus where the price of the share, final price, at what price they are issuing to the public is not given, it is called red herring prospectus. Okay. So that specific detail is omitted, the pricing basically. Okay. Once that thing is finalized, they will give that update. It is normally given in IPOs where once the subscription is made, the shares are allotted based on the demand. Some price is fixed after the money is received. Okay. So one red herring prospects are given mostly in IPOs only. Okay.
But sorry to disturb you, sir. But nowadays IPOs they are declaring the price earlier. Then only they are.
They will give a range. They will give a range. The price may be between this price and that price. They will give a range.
Minimum and maximum they will give. Maximum
Yes.
they are allocating maximum price only.
No, it depends. They may not even allocate if there is no subscription. Say, let us say,
that is,
if they are issuing 1,000 rupees shares and they are getting subscription for 10,000 rupees, they will issue at maximum.
Yeah, yeah.
But they are getting application only for 1,000, then they will
revert.
They will not give it some other rate. Okay, because there is no demand for the shares, so they may give it a lesser price.
Yes, sir. Minimum price or discounted price.
Yes. So for such things, we call it as a prospectus is given without any specific price. That is red herring prospectus. Okay. So are you clear?